Hi, everyone. Thanks for joining us. I'm Brian Martinez with NuView Trust Company, and I'm really happy about bringing our guest today. His name is Artem. He's with FarmTogether. He's been on some of our webinars in the past. Right now is great timing because there's a lot of volatility in the marketplace, and a lot of people are searching for alternative ways and places that they can invest their self-directed IRAs. So that's why I brought Artem in. I want to give you a different perspective on something that we haven't talked too much about, but a lot of people are researching right now. Hey, Artem, how's it going?
Hey, Brian, good to be back.
All right, welcome back, buddy. We're really happy to have you. Just tell the audience a little bit about yourself, who you are and where you're from, and some background on FarmTogether.
Yeah, absolutely. So I'm Russian-Ukrainian background, which is very challenging and very tragic these days. I grew up in Moscow, moved to Canada in 2007, and been in finance in Canada for about 10 years with a lot of focus on food and ag before starting FarmTogether in 2018.
All right. And how long have you been with FarmTogether?
So since 2018.
2018. Okay. So yeah, we have a lot of questions for you here. I'm just gonna dive right into the questions, some of the things that we've been receiving questions on. So right now, the farmland market, what's the size of that market look like?
It is a huge market. I mean, in US alone, it's $3+ trillion now. This is broken down between pasture land as well as crops. And in crops, you have what's called permanent crops and raw crops. Raw crops is your corn and soybean, permanent crops is your trees, your fruits and nuts. And roughly it's about 2 trillion plus is in crops.
Very interesting. And right now investors are looking for ways they can put their money in things that are I want to say a little less volatile, something tangible, something they can see. So why haven't investors had access to invest in farmland previously? Is this a new thing?
It's definitely not a new thing. It's one of the oldest asset classes. I think the new thing is that just there hasn't been really any platforms to invest in farmland. And so that was one of the primary reasons that I started this now 4 years ago. I think part of it is just emergence of alternative investments is a relatively new phenomenon. And so farmland is just following in that trend. And part of it is that, it's not a market that a lot of people know. So there's not that many kind of natural innovators, not to pat myself too much on the back, but I do have that unique Venn diagram of experience in tech, in finance, in marketplaces. Before FarmTogether, I was also for about a year at a B2B marketplace in fruits and vegetables called Full Harvest. So I think I just had like this really good overlap of different experiences to start FarmTogether. But having said that, I think the reason that we've been successful to date is that there's just so much going on. I mean, from demand for alternative investments, demand for ESG-centric investments, demand for investments that are inflation resistant. I mean, as we're talking right now, this March 2022 inflation, I think latest number printed 7.9%, which is just absolutely insane. And so I think there's, the demand is just skyrocketing for real assets, for assets that can withstand what is a very, very tumultuous, very volatile environment. I mean, yeah, it's just so much going on the demand side. And then, Brian, on the supply side, the key unlocking tech, I think, has been emergence of satellite imagery, emergence of digital documents, automation of underwriting in other asset classes like real estate that's now passing over to farmland, just getting much more comfortable in using technology to actually analyze investments. If I look back at my job 10, 15 years ago, I would open up a good old Excel and I would get this information here, this information there, and take me days and days to underwrite. But now, information is, you can pull it from different sources. There's so much technology. It's getting cheaper and cheaper. Machine learning, AI, natural language processing, where you can grab a listing and put it into a model in a matter of seconds. And so it's a night and day versus even 4 years ago. And that's really unlocking, I think, a lot of capital for farmers and landowners.
Yeah, that's totally interesting. We're definitely in a different era right now, and things are evolving and things are changing. And the way people invested their money, 10 years ago has changed, in the small amount of time that, I've been with NuView, and I've seen, how markets can go up and they can go down, and how people can panic and then they can lose a lot of money. So this is why I love what I do, because I get to learn about all these different alternative assets that clients might not have known about or had access to by networking with people like yourself. So, I've learned a lot from having you on the show before. So what are some pitfalls if I was a new investor learning about investing in agriculture, like what kind of due diligence can I do to make sure I'm making a good investment?
Yeah, for sure. And look, I think one is like with a lot of other types of investments, in a lot of ways, you have to have a certain level of trust to the investment team, underwriting team. Now, our team comes from funds where we invested in Farmland in ag before on behalf of large financial institutions. So we do have that institutional kind of systematic way of thinking about investing that is unemotional, data driven. And so hopefully, our track record, what we have done to date, both personally and as a company, will be a strong enough due diligence item for you. But if you wanna, and we fully encourage it, dive deeper, then here's how to think about due diligence on farmland ag investing. When we think about farmland, it's this really interesting asset class. It's kind of something in between real estate, infrastructure, timber even, bonds to some extent. And so how do you analyze this? Well, I think real estate is the best lens through which you can look at farmland. So one, you have to look at what is the price you're buying the farmland. Because if you're overpaying, then it'll be harder for you to make money. So make sure that what we do is that we look at comparables in the space. What is this farm selling in other places? We do what's called the DCF, discounted cash flow analysis. We forecast the future cash flows of the farm. And because at the end of the day, an asset is what is the cash flow? And then we do what's called the cost replacement analysis. We had to replace this farm, replant the trees. How much would that cost? Things like that. So that's step one. And that's what we do. And you can take a look at how we do it in our materials. After that, it's also making sure that you have a good grasp of where the crop prices are and where they're going to go. So for us, we typically take a historical 10-year average of the crop price and make sure that our forecasted prices are in line with that 10-year. So we're not suddenly going to say, hey, we're going to put almond prices at $4 if historical has been like 2.5, 3. So I think that's really important. And then the exit price, which is driven by the price appreciation of land. So to give you a sense, and to your listeners, in the last 50 years or so, average price appreciation for land has been about 5.9%. So it's been quite strong, and that's been driven by inflation, increase in population, and decrease of farmland supply, and increase in farmland productivity. So it's a fairly good number to kind of as a baseline. So we use something around, depends on the region, called 4, 5, 6% of land price appreciation. Last year it was 10 plus in a lot of places, so it's been quite a strong year. And then of course you have to take a look at the farmer operating. So in our case, we work typically with really experienced farming families, farming groups that have been in the business for generations, and we're using a full-time farm management team that all the work is just to oversee the performance of the farm, as well as an accounting and finance team. So there's a lot of people working and overseeing your farm, and that's what you want to make sure is the case. And then for California, everyone now is an expert on water in California, it seems, but make sure that the water is secure. One of the few ways that a farm can lose value is if it doesn't have water, because it's hard to screw up a farm, honestly.
Imagine.
So in this case, we do a lot of due diligence on water. Oftentimes, we want to make sure there's 2 sources of water. The wells have sufficient depth, the water table is right, the water rights are correct. I mean, it is a Byzantine network of water laws. I mean, I could probably write a exciting thriller that would take place in like the water rights and water trading in California. It's a fascinating space, but we have really good expertise there. And then there's some other things, just making sure that the model, the financial model, things like the input costs are right, you have sufficient reserves to weather headwinds like the one we have today. Fertilizer prices and gas prices are up substantially. So our models all budgeted for that when we have put up sufficient reserves for this type of scenario.
Okay.
Yeah, there's a lot that goes into it, but to kind of summarize, if you go to a website and go through a deal page, we put together a summary of key risks, and you can read them in a more accessible manner. We just rank the different risks, like 8 of them, and so you can make a quick decision on that as well.
So there's actually options that investors can choose from on the different, is it the type of agriculture that they want to invest in?
Type of agriculture, type of setup of the farm, because you have different types of financial products that we offer farmers. It can be a rental model, it can be a direct operated model, it can be everything in between, fixed lease, variable lease. Sometimes a farmer wants to buy the farm back, so we do that, and so there's a fixed price at which they buy it back. So there's a lot of different scenarios that exist on the farming side. And then the crops themselves, yes, you can be, corn and soybean, you can be almonds, you can be organic, regenerative, California, Oklahoma, Washington, apples, pistachios. Okay. I mean, you pick and choose.
That's pretty cool. And what makes this type of investing recession proof?
So historically, Farmland has done really well in periods of recession. So I look at the 2 latest ones we had, the COVID in 2020, and then the great financial crisis 2008. So during the great financial crisis, when everything was down 40, 50%, Farmland overall was up almost 15, 20%, really strong performance. And during COVID, Farmland was essentially flat, a little high, and sort of like just modest increases, while everything again, if you remember, March, April 2020 was down. People were like, the world is ending. And the reason for that, and it's the same for other sort of less acute financial crises, like Farmland overall has quite low volatility. It's kind of steady as she goes type of investment. And the reason for that is that, well, Farmland kind of marches to the beat of its own drum. And when you think about it, like, it's really, for Farmland, it's people need to like stop eating. And that doesn't really happen. And so even if they have financial crisis, well, that's great. I mean, God forbid you got fired, but you still have to go home and eat. You might not be buying organic, sustainable almonds. And so that's why, almonds might be a little more kind of higher volatility, but you're still going to eat bread, you're still going to buy pasta. And so the basic commodity things are quite, the demand for them doesn't really change that much in the grand scheme of things. And so that's why, in my view, it's recession resistant. And then secondly, I think what a lot of people don't realize, but Farmland overall has actually very low leverage. So if you look at stocks, if you look at real estate, leverage is like 50%, 70% real estate. You can do real estate deals like 95%. The debt to asset ratio in Farmland, like I bet no one of you listeners will guess this, but I'll pause for a second, let people guess what it is. It's 13%, 1-3. It's extremely low leveraged asset with also interest rates supported by Farmer Mac, so they're low interest rates that are fixed. So another way that you can actually, another risk that I didn't mention, but what's the debt ratio on a farm? And a lot of farms doesn't have leverage, like on our raw crop deals, we don't have leverage, and that just makes it a very resilient investment.
Yeah, I didn't know that the leverage is so low. I really didn't. It's a cool fun fact you just shared there. Congratulations on the wine deal. I was talking to Rebecca. She's gonna give me a little feedback on that one. Give me some more details on it.
So I can't tell you too much because kind of talking about deal specifics in a public forum. I encourage people to go check out the deal on our website. But in short, it's an organic wine grade deal that was sourced by a new team member, Gretchen, who is a vineyard aficionado, vineyard professional. And yeah, we think it's our first wine deal. We think it's gonna do quite well. It's kind of modest returns, but also, what we see as appropriate amount of risk at about 8-9% target net IRRs, good cash flows. I wish I could say more, but the lawyers.
No, I understand. No, I appreciate the little snippets you gave us, some information on that. But like, this was a great interview. You gave me a lot of really good things that the clients can take away with them, and they can do their own due diligence and their own research. You shared your expertise in the field, and I think it's going to go a long way. You have any questions for me?
Brian, I'd love to hear kind of what are your investors most interested in, How is NuView doing?
Yeah, so NuView is doing good. We're, so like I said, things are changing. 2 years ago, we were seeing many people wanting to buy real estate in their IRAs, but now more people are looking for more passive types investments that don't require the landlording and not having to keep up with properties. So we're seeing right now a lot of people doing more private lending. We're seeing a lot of more people buying more investments that are like in private companies, private equities, LPs, things like that. And it's just a trend, it's always up and down and the markets change. And, I think it has a lot to do with, inflation right now and the recession we just passed. And people are saying that the real estate markets are going to be changing. We don't know if we'll see a dip. Right now in Florida, the market's still pretty good, but it's low inventory. And I am hearing that pretty much a lot of the big cities, there's not very much inventory, but so it's definitely a seller's market more than a buyer's market. So I think that's what's keeping our clients from buying more real estate at the moment. But personally, I like the passive way of investing as well. I don't like to have to get my hands dirty. I just like my money to be able to work for me, even if it's not as high maybe returns that I'm going to get if I were to do the work. Which, using a self-directed IRA, you want to keep it a passive investment. You want to keep it at arm's length. So yeah, things are changing, evolving, and we want to get word out on, a variety of alternative assets that more clients can get involved with. Awesome, man. Well, I appreciate you coming on the show. Reach out to me. I'm glad we got to connect, and we'll definitely be in touch.
Thanks, Brian.
Awesome. Thanks, Artem.